name is Christy Talatayud. So my assigned topic will be effect of value-added tax on deduction. Effect of value-added tax on deductions when purchases of goods or services are made from VAT suppliers. Taxpayers will pay the VAT passed on by the supplier. To the seller's perspective, this is called output VAT, but to the buyer, this is called input VAT. So value-added tax or VAT is a consumption tax added to the value of goods and services at each stage of the supply chain. When it comes to deduction, VAT have both positive and negative effects. Deduction from gross income are expenses that individuals businesses can subtract from their taxable income. This deduction help reduce the amount of income that is subject to taxation. Next is the general principles of deductions from gross income. Number 1 is expenses must be legitimate, ordinary, actual, and necessary. Number 2, the matching principle. Only business expenses which contribute to or more or are incurred in connection with the generation of income gain or profit subject to regular income tax are deductible. Number 3 is the related party rule. In case of transactions between related parties, gains are taxable but losses are not deductible. Also, pursuant to the transfer pricing rule, non-arm's length expenses incurred between associated enterprises may be restated to their arm's length fair values to reflect the correct income of each of the associated enterprises. Number 4 is the withholding rule. No deduction is allowed unless the withholding tax required by the law or regulation to withheld on the income payment is withheld and remitted by the taxpayer to the government. So the general principle of deduction from gross income is important for individuals and businesses to effectively manage their tax benefits within the legal framework. It is advisable to consult with a tax professional or accountant to ensure accurate and compliant deductions. Next is the loan principle. A deductible business expense is legitimate, ordinary, actual, and necessary. Characteristic of legitimate business expense is: Number 1, it is incurred in and for the current taxable period. Number 2, it is not capital expenditure. Number 3 is it pertains to the business or professions of the taxpayer. Number 4, it is not contrary to law, public policy, or morals. Number 5 is it is adequately substantiated with receipts or other documents. The loan principle, also known as the principal amount, refers to the original amount of money borrowed in a loan agreement. It is the initial sum that the borrower receives from the lender and is obligated to repay over a specified period, along with any applicable interest charges. The loan principle is essential for borrowers to manage their debts effectively and plan for repayment. Next is, what is an ordinary and necessary expenses? An expense is necessary if reasonable and essential to the development, management, operation, or conduct of the trade, business, or exercise of professions of the taxpayer. It is ordinary when it comes to normal in relation to the business of the taxpayer and the surrounding circumstances. A deductible expenses must be both ordinary and necessary. An ordinary business expense may still be disallowed by the BIR if unnecessary or unnecessarily or unreasonable, taking into consideration the context of the expense and nature of the taxpayer's businesses. So the ordinary and necessary expenses refers to the types of the expenditure that businesses can deduct from their gross income when calculating their taxable income. These expenses must meet specific criteria to be considered deductible. This is the factors in assessing reasonableness. There is no fixed test or clear-cut criteria in determining reasonableness of an expense. In CIR versus General Foods, it was held that reasonableness will be judged on the interplay of many factors, such as but not limited to the following. Number one is type and size of business in which the taxpayer is engaged. Number two is volume and amount of its net earnings. Number three is nature of the expenditure itself. Number four is intention of the taxpayer. Number five is general economic condition. The burdens of establishing the validity and reasonableness of the expense rest upon the taxpayer and not upon the taxing authority. So the factors in assessing reasonableness is assessing the reasonableness of a decision, action, or expense involves evaluating various factors to determine if it is fair, justifiable, and appropriate in given context. Next is what is meant by actual expense. An expense is actual if it is paid or resulted to incurrence of an obligation to the taxpayer. In case of loss, it must be sustained or realized by the taxpayer in a closed and completed transaction. Meaning of closed and completed transaction: a transaction is said to be closed and completed when no further transaction emanates from its occurrence. In other words, no right of recourse for indemnification from the parties exists. For example, a fire loss in insured property cannot be said to have been sustained in closed and completed transaction because its occurrence gives rise to other transaction. The claim for reimbursement. What is meant by the actual expense refers to the real and tangible cost incurred by an individual, business, or organization in the course of conducting their operation in or activities. Next one is examples or non-deductible expense under this rule. Number one is decrease in value of properties or investments, such as this decrease in value of securities such as stocks or bonds. Letter B is decrease in value of foreign currencies or foreign currency denominated receivables. Letter C is decrease in value of machineries, equipment, and building brought of obsolescence. Number 2, estimated future losses such as estimated loss on bad debts or uncollectible or receivables. It is estimated loss or losses not yet confirmed by a final judgment. Number 3 is loss on properties covered by the insurance or indemnity contracts. These losses are merely temporary and may reverse until they become actually sustained upon final settlement by the insurer. So, under the tax laws and regulations, there are certain expenses that are considered non-deductible, meaning they cannot be claimed as deductions when calculating taxable income. These non-deductible expenses do not meet the criteria of being ordinary and necessary, or more specifically, disallowed by the tax authorities. The matching principle. It is well established rule in income taxation that Only business expenses that are incurred for the generation of items or gross income subject to regular tax are deductible. This is a per- pervasive criterion that is consistently observed by the NIRC revenue regulations and the BIR rulings. Let us refer to this rule as a matching principle. Business expenses incurred to generate items of gross income that are either exempt or excluded from taxation, subject to final tax or capital gains tax, or to a special tax regime, must not be matched or deductible against gross income subject to regular tax. The matching principle is an accounting concept that dictates the matching of expenses incurred during a specific period with the same period. This principle ensures that the financial statements accurately reflect the financial performance of an entity by associating expenses with the revenues they help generate. The related party rule. Gains realized between related parties are taxable, but losses are not non-deductible. The rule is intended as a control measure due to the fact that related party transaction can be easily tailored in a way to evade taxes. This rule is particularly relevant in the claim of losses, bad debts, and interest expenses. So the related party rule is refers to the regulations and guidelines that governs transactions and relationship between parties who are considered related or have a close connection. These rules are designed to ensure that transactions between related parties are conducted at arm's length and are fair and transparent.